Hello, folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is Spotting the Trade. I'm going to get you folks what you need to know before you roll, and that's going to be talking about the economic data, how that impacts the overall markets with some market analysis, maybe sprinkle in a little geopolitical fodder to round off that market analysis, and then talk about some option strategies we could implement into a portfolio based on those assumptions. So without further ado, let's get on with the economic data, because this week is pretty chock full of economic data. Yesterday, remember, we did get the Institute for Supply Management prices paid number there. That number came in a little bit hotter than expected at 82.7. We also got the vehicle awards vehicle sales. That's a big, broad economic data point that really tracks the number of new vehicles sold here in the United States. We got 12.7 million units sold, and it was expected to be a million more than that. So while we're seeing part of this supply issue with cars, I'm actually even hearing Ford's not selling anything over a 350 truck to anybody but a preferred customer. So that's going to also really cause used car prices probably to sustain a little bit, at least for the trucks. Those have been elevated. As a matter of fact, I've talked about this. You don't see an MSRP on trucks anymore. It's basically everyone's price, which means it's a retail price, probably even higher than that. That said, a couple of economic data points that we got today that could soften this a little bit. We got unemployment claims. That initially made us believe, since it came in lower than expected, that's a good thing. 200,000, expected to be 210,000. Less people are claiming unemployment. That would expect that those folks are getting employed. But we didn't really see that coming in on the Challenger job cuts. That was a higher than expected number, negative 15.8. We also got the building permits coming in a little bit lower than expected. The labor unit cost higher than expected, 12.6. That's a good thing. We're seeing labor get a little bit of wage inflation here. The reason why is because if you compare yourself to last year this time, you need to make about $6,000 more than you did last year at this time. So, and that's the average human on the United States. If you're even more over the median, then you're going to be paying a little bit more in inflation, if you will. We also got, I'm scrambling here because we got another economic data point on, oh, you know what? Initially, jobless claims, ADP non-farm payroll. That's what I was looking for. This is one of the precursors that gives us the big number for the first Friday of the month coming out tomorrow, Unemployment Friday. That's where we get our non-farm payroll numbers. ADP is a little bit of a precursor. It's not always the one that we look at because it's off quite a bit. Comes in at 128,000, expected to be 295,000, or almost 300,000. And last month's number also got revised down by almost 50,000. So big miss, massive miss on the ADP non-farm payroll or employment change, meaning less hires than what was expected. While we're all feeling the pinch of inflation, needing to make more money, this number here showing that folks are not hiring. Why? Because they're worried about a slowdown right now. We're already seeing things like Carvana start to lay off well ahead of time. Is that because of bad business practices? I'm just not running a good business. That could be part of that. But what we're going to be looking at is the rest of the markets and how they are going to be fighting this uphill battle here. So let's get on with the overall markets. We've got Google up here. I don't know why Google's up here. I was checking out some different underlyings. We've got, this is really what I want to get to. I'm going to skip over most of these because we've got crude oil that started making a bit of a top yesterday and not really following through with that today. So we'd like to see this little bit of a roll over here, folks, because I've been talking about this. One of the biggest crunches to the economy is the amount of money that we're all putting into crude oil. And I've talked about this. If you look around, every person you look at is probably spending somewhere between $20 and $50 a week more towards gas than they are elsewhere in the economies. That means that you aren't going to be buying a dessert when you go out to dinner. You might even skip a full-on going out to eat. You might not go to the movies and see the new Top Gun movie because you're pulling back on some of your spending a little bit there. So with all of those things said, that is what is really going to start slowing the economy. And on top of it, we're going to be jacking up interest rates going forward here, as the Fed is going to probably jack interest rates in the next 2 to possibly 3 meetings. We saw the beige book yesterday showing a little bit of weakness there, but the inflation is the thing that folks are going to be really concerned about at the FOMC there. So crude oil driving higher is just only going to cause more problems here. If we can get this to roll over, crude oil to come back off a little bit, that will really cause a lot of these inflationary pressures to subside a little bit. And that is desperately needed right now. One thing I wanted to talk about this with NASDAQ, because yesterday I was playing around. And you guys remember back, if you've been following this for quite some time, when we were looking at these charts up here, we were looking at a couple opportunities back in the day, it seems like, that we were going to be, I don't want to be doing that. Actually, I want to get my pen, sorry. When we were talking about this head and shoulders pattern right here, we got the shoulder. As soon as we started building out the head, I said, we need to start watching out for another shoulder being built out there. Now, I called this the second shoulder there, and drew in my neckline. That neckline, I guess you don't want to open up. Let's see if we can get it to work. So driving a little bit of a head and shoulders pattern there. So with that said, I'm just going to skip over to this here because I flipped this picture upside down. This is the same chart as you can see here. I just took a snapshot of it. We've got our head and shoulders pattern. The reason why I wanted to be able to do this is because, or actually, here you go. You got your head come down. There's your neckline, building out the next shoulder, did not breach the next neckline, which is indicative of a head and shoulders pattern. We kind of rejected away from that, but that was the real sign of weakness at the top of this move. Now, with that said, we've got a big sell-off. We've had a nice big correction here. We've come down, tested several key support levels. The correction, bearish correction, 20%, whatever you want to call it. We flipped this upside down, and something that I wanted to be able to, oh, I bet I can do this. There we go. You're going to let me do it? Mark up. Oh, sweet. So on the flip side, when we flip this chart upside down, it just makes it a little bit easier for folks to see head and shoulders patterns. Even myself, I was actually patting myself on the shoulder based on the fact that I picked this up, and it's not always the case. But what we're seeing here is a bit of a shoulder here, the head pattern, shoulder lower than the top of the head. We drop down. Now, if we build out a bit of a shoulder here, that would make us want to retrace to check the neckline. All right. So those are what we would be looking for in this type of trade. Now, keep in mind, let me see if I can save as a copy, I guess, because I want to try and get this to flip. Let's just say save and get it to flip. Oh, anyway, sorry, guys. Let's see if I can get this to come back again. Figure out a way to try and flip it back over so you can see it. Head, there we go. Come down, shoulder, neckline, break the neckline. And I don't know. I guess it's not going to let me rotate it back so you can see it without really trying to break a bunch of brain cells. But anyway, at the end of the day, we can see that if we take that, actually, yeah, I don't want to save it. That same pattern is happening right here. It's just flipped upside down. So a little bit of a rotation down, let's call it. You know, you don't really want to break too far below, let's call it even 12,000 there to keep this pattern intact. It really could go down as far as, let's say, 11,500 even. The last thing we want to do is see it break below the top of this, or the bottom, I guess I should say, of this head and shoulders type pattern here. Now, a little bit of a preview here would make this really want to snap back. That's what head and shoulders happen to do. When you break that neckline, they really have a tendency to exacerbate that move, and we could see this happen to the upside. As a matter of fact, the 50-day simple moving average would be an easy target to try to go to if we are starting to confirm that head and shoulders pattern. Again, we're seeing this in the E-mini S&Ps. The bottom shoulder, the head pattern coming up, breaking down, creating another shoulder pattern here. I do wish that this thing, I don't know why this doesn't work sometimes. Maybe it's hidden somewhere. I can't find. All right, so I'll move on, figure that out for tomorrow. But head and shoulders pattern there starting to show up across the board in most markets. One could even say that we've gotten a bit of a head and shoulders pattern starting to build out here in gold, upside down, building out. Really what the head and shoulders does is it shows you that inventory of folks really battling it out at the top or at the bottom of a move and who's going to win. So again, seeing another head and shoulders pattern indicative of building out a bottoming pattern. We talked about crude oil a little bit here with the way that this is going to be affecting you and I in our spending patterns. This is a bullish trajectory. It does not look like there's any sign of weakening demand necessarily, maybe a little bit of weakening demand through the manufacturing sector and through you and I probably not traveling as much just on choice. But the real thing here is the lack of supply coming into the overall markets. And most of that is due to the United States. And we're kind of adding in a little bit of Russia because remember, Russia's a big supplier of crude oil and we're limiting what happens there. Now, don't get me wrong, I don't disagree with that at all. But what we need to do is make up for it somewhere else. And that's probably here in the United States. So we're really driving these prices higher, or at least helping aid these prices moving higher. And I've even said it. I wonder if this administration right now is actually consciously allowing inflation to move higher. And one of the reasons why is because of this crude oil. If you continue to allow this to move higher without making any types of moves in order to slow that trajectory, then I think you're a part of the problem, in my personal opinion. So crude oil could continue to sit here and climb to 200. We are already seeing record prices across the United States. Even here in Arizona, gas prices are right around $5.50 a gallon. I can't imagine what it is in places like New York, especially California. I'm hearing like $8 in California. So they're going to be looking at $10 a gallon in the next few months if we continue this type of trajectory. We don't have to make much more of a move here to get to those types of prices, especially in California. And that is really, can you imagine filling up a 15-gallon tank and it costs you $150? Really? Okay. Anyway, that's the kind of paradigm we're looking at. And listen, we can't just switch over to electric vehicles, folks, because that drives inflation almost as bad because of the amount of mining that goes into getting the metals that goes into the car, right? So, and those mining operations are driven specifically from diesel fuel. So those prices are through the roof as well. All right. That's about all I got for you guys, folks. I would be looking for a pullback here in equities. Don't jump on board just yet. Maybe I'd say just a couple of percentage points off here to create that other shoulder that we were talking about in the equities, whether it be the NASDAQ, the Dow Jones, or E-mini S&Ps. All of those folks are starting to set up with these head and shoulders patterns at the bottom of a move. And I thought today would be a perfect opportunity to show you guys some folks with maybe not as trained of an eye, and even my eye is not trained well enough to see head and shoulders too often, but you know, we got to celebrate those wins when we get them. So this is another opportunity, I think, to look for that building out. We're not getting in too early and making sure we are confident of this bottoming pattern here before we start getting involved. All right, that's all I got, folks. Today we're going to be doing a webinar on the long call butterfly. I'm going to show you how we build that out. Actually, we'll even talk about specific strike locations that one needs to use for this type of strategy. We'll be talking about the deltas, so you guys have a really good idea as to where you're going to be putting your locations. And the other thing is I'll talk about what type of credit or debit you would need for any type of strategy before you move forward, so that you guys have the tools you need to make the informed decisions before you make that trade. All right, so that's all I got. If you can't take that, take it easy.